The market is currently closed as of September 26, 2025 at 4 p.m. Eastern Time. The last recorded closing price for Rezolve AI PLC, ticker RZLV, was $5.95, representing a significant drop of over 10% on the day. That sharp, painful single-session move to the downside is a perfect illustration of the tension between investor expectation and reality when it comes to high-growth, high-multiple AI names. While many investors are conditioned to see a stock like RZLV, which is tied to the massive growth narrative of artificial intelligence in commerce, as a permanent upwards-only trade, the reality is that such a precipitous drop is often less about a catastrophic business failure and more about capital market mechanics and the unforgiving nature of valuation in a rising rate environment. The unexpected part of this recent sell-off, the insight you don't immediately get from the price ticker alone, is that this steep slide came despite the company announcing a substantial $200 million oversubscribed financing round just days earlier. A large capital raise, especially one anchored by existing fundamental institutional investors, is typically viewed as a massive sign of confidence and stability. Yet the stock sold off. This immediately establishes a curiosity loop, forcing us to ask, why did the market greet a huge cash infusion with a 10% haircut? The common expectation is that a $200 million vote of confidence strengthens the balance sheet and de-risks the company, which should logically boost the stock. The reality, however, is that the details of that financing, the structure, the valuation at which the new capital was raised, and the implied dilution can override the headline figure, especially for a stock like RZLV that has seen tremendous volatility, trading between a 52-week low of about $1.07 and a high of $9.45. The fact that the stock had been forming what technical analysts refer to as a hammer chart pattern earlier in the week, an indicator that suggested a potential bottoming of selling pressure, only to be followed by this aggressive move lower, tells us that the immediate force of trading volume, which was high at nearly 20 million shares, is dominating fundamental conviction in the short term. This stock is currently a playground for momentum traders and short-term systematic funds, an important factor to consider for anyone comparing this activity against a long-term plan they might have with their online investment strategy or through an intelligent portfolio like a Schwab Intelligent Portfolio setup. Let's challenge the general belief. The market narrative for AI stocks, broadly speaking, think NVIDIA stock, is one of inevitable exponential growth, where today's losses are merely rounding errors on the way to trillion-dollar valuations. For Rezolve AI, which specializes in AI-powered commerce solutions, the expectation is simple. They are building the AI layer for a large part of the global retail transaction structure. They partner with titans like Microsoft and Google, which adds tremendous credibility and fuels the high-growth story. The contrarian take is that the spectacular revenue multiples, with a price-to-sales ratio hovering near 5,700, demand perfection and a flawless path to profitability. Any sniff of dilution, any concern about the cost of customer acquisition, or any question regarding the timeline to positive cash flow will be met with a brutal repricing. The $200 million cash injection, while crucial for scale and potential M&A, as stated in the company's press release, also highlights the enormous capital burn rate required to scale a complex enterprise-facing AI solution. This is the friction point. Investors who believe in the long-term investment story are buying the dip, while those focused on short-term valuation metrics and capital structure are selling on dilution fears, and that battle is what drove the nearly 11% drop. Expanding into the full analysis of the recent movement, we have to look beyond the last trading session. Over the past month, the stock has been extremely active. Earlier in September, Rezolve AI announced the resolution of all private placement warrants issued in December 2024. Warrants are a form of overhang, potential future dilution that can depress a stock price. Eliminating that overhang should theoretically be a bullish event. Then there was news of a high-profile executive hire from Microsoft's retail division, a clear move to accelerate adoption of their AI commerce platform, a strong signal of commitment to growth. Adding to the buzz, the company had a positive reaction to Tether's stablecoin announcement, given their push into crypto payments, which for a moment gave the stock a significant upward jolt. All of these positive corporate developments create a floor of institutional interest. In fact, institutional ownership has recently surpassed 10% of the capital structure, with major players like Citadel and BlackRock taking positions. This institutional accumulation, often tracked by users of interactive brokers or Fidelity's research tools, is a fundamental sign of validation. However, the price action, the drop from its high of $9.45 to the recent $5.95 close, suggests that even this strong institutional support has not been enough to combat general market skepticism toward non-profitable, high-multiple names in the tech sector. Especially when a significant financing event creates a liquidity event for some investors or simply provides a convenient window for short sellers. The high trading volume confirms that conviction is meeting resistance, leading to the dramatic daily swings. This level of volatility is what makes an individual brokerage account trade like this more a speculation than a stable long-term allocation, which is why self-investing in such names requires a strong stomach and a clear thesis. For those curious about the nuts and bolts of what Rezolve AI actually does, the core business model is centered on proprietary AI-powered commerce solutions and engagement. They offer a platform that simplifies the purchasing process for consumers. Think seamless transactions, visual search capabilities, and personalized offers facilitated by AI. The key is their focus on building authentic and profitable consumer connections for retailers, brands, and manufacturers. Their technology is designed to sit at the intersection of retail and AI, leveraging large language models and patented technologies to enhance the mobile commerce experience. They aim to be a scalable software-as-a-service (SaaS). While the concept is strong and clearly resonating with large enterprise customers, including a significant $9.8 million annual deal with a major Mexican retailer, the financial reports are where the expectation and reality diverge most sharply. The company has a current market capitalization of approximately $1.45 billion, but a trailing 12-month revenue of only around $187,000. This tiny revenue figure relative to the massive market cap is what drives the outrageous valuation multiples and the inherent risk. They are a pre-scale company being valued on pure future potential, similar to how many early-stage biotech or pure-play space stocks are valued, which is a different calculus entirely from evaluating a titan like Apple stock or a mature financial platform through Fidelity Investments. Past performance is not relevant here because the company is in an inflection point where future ARR matters far more than current TTM revenue. They project exceeding $100 million in ARR in 2025, and it is this promise that justifies the institutional interest and the current valuation. The $200 million financing is the fuel for this ARR growth engine. Looking ahead, the future outlook for RZLV hinges on execution. The market will be watching two things. First, the earnings report, which is expected in early October. While analysts predict a consensus EPS forecast of around -0.03 for the quarter, the real focus will be on the updated ARR figures and customer acquisition metrics. Missing those internal projections, even by a little, would be interpreted as a catastrophic failure of the growth thesis and could send the stock sharply lower, just as exceeding them dramatically could spark a short covering rally. Second, the deployment of that new $200 million. The management has indicated they will use it for accelerated investment in their sales organization and potential accretive M&A. The successful integration of an acquisition or a significant visible enterprise contract announcement would be major catalysts. The risk, of course, is that the high burn rate continues without a corresponding acceleration in high-margin revenue, pushing the negative equity further and fueling more dilution fears. This is the classic high-risk, high-reward profile that is a stark contrast to the stable, intelligent portfolio choices on platforms like SoFi Invest or the reliable growth of Tesla stock. For the casual investor watching this intense back and forth, I want to hear your personal assessment. Comment below what specific metric, ARR, cash on hand, or institutional ownership, you think matters most for RZLV stock price over the next 6 months. In closing, the story of Rezolve AI stock price is a living case study in the tension between the narrative and the numbers. The narrative is pure AI gold, partnerships with tech giants, massive market potential in AI-driven commerce, and a fresh $200 million in the bank from savvy institutional players. The reality, however, is a tiny current revenue base, an astronomical price-to-sales ratio, and a stock price that reacts violently to the structural mechanics of financing, even when the news is ostensibly good. The recent 10% drop on the heels of a massive financing announcement perfectly encapsulates this struggle, showing that for a company trading on future potential, capital market factors like implied dilution and short-term liquidity events can briefly hold more sway than the long-term fundamental promise. The expectation of perpetual AI-fueled growth is constantly